If you want to start investing but feel lost in a sea of complicated information, this video is for you. The truth is, most people never learn about money and invest in the right way. That's why they spend their entire lives stuck in the rat race, trading time for money without ever truly building wealth. But investing doesn't have to be complicated. With the right concepts, anyone can take the first steps and start making money work for them. In this video, you'll discover the essential fundamentals that every beginner needs to know to invest safely and wisely. We'll cover the importance of escaping the rat race, avoiding common mistakes, understanding how money grows over time, and building a real path to financial independence. If you want to learn how to invest the right way and start transforming your financial future, stay until the end because what you'll learn here can make all the difference in your life. The rat race is a vicious cycle in which most people find themselves living paycheck to paycheck without ever truly building wealth. You work, get paid, and before the next month arrives, all your money is already gone spent on bills, debts, and daily expenses. Even when you get a salary increase, your expenses rise along with it, and the feeling of constantly chasing money never goes away. This cycle is dangerous because it keeps people trapped in job dependency, with no financial freedom and a constant worry about the future. Escaping the rat race requires a shift in both mindset and financial habits. The first step is to reduce expenses and live below your means. Many people spend everything they earn, assuming their paycheck will always cover their costs. But the reality is that without planning, any unexpected event can lead to debt. Controlling spending and cutting unnecessary expenses is crucial to starting a solid financial journey. Beyond managing expenses, it's essential to create sources of passive income. Relying only on a paycheck means you are stuck trading time for money, but investing in income-generating assets allows your money to work for you. Investments in stocks, real estate funds, and personal businesses are ways to build a financial foundation that grows over time. Your mindset also needs to change. The wealthy don't work for money, they make money work for them. This means learning about investments, avoiding bad debt, and continuously improving financial knowledge. The more you understand how money works, the easier it becomes to make smart decisions and break free from the rat race. This cycle keeps millions of people trapped, but anyone can break out of it with strategy and discipline. The first step is taking control of your finances and starting to build a path toward financial independence. The main reason many people stay poor isn't a lack of effort or intelligence, it's how they manage their money. The biggest mistake that keeps people trapped in poverty is spending everything they earn. Most people work hard, get their paycheck, and without any financial planning, spend all their money on bills, entertainment, and daily expenses. When they get a salary increase, their expenses rise just as fast, and the cycle repeats itself, leaving nothing to invest or build wealth. This behavior is dangerous because it creates a false sense of security. People assume they will always have a paycheck at the end of the month. But the truth is that relying solely on a job to pay your bills makes you vulnerable to crises, layoffs, and unexpected expenses. Without an emergency fund and investments, any financial emergency can push you into debt, making your situation even worse. Avoiding this mistake requires discipline and a shift in mindset. Instead of spending everything, adopt the habit of paying yourself first, setting aside a portion of your income for investments before spending on anything else. Building an emergency fund and starting to invest, even with small amounts, can make a huge difference in the long run. Small, consistent contributions grow over time and become a powerful financial safety net. The secret to escaping poverty isn't just making more money, it's managing what you already have. Those who learn to live below their means and invest consistently can build wealth over time. On the other hand, those who spend everything they earn will always be chasing money, never achieving true financial freedom. The path to wealth begins with small daily changes and a commitment to making money work for you, not the other way around. Financial independence means having enough money to live without relying on a fixed paycheck. In other words, it happens when your investments and passive income sources generate enough money to cover your expenses. This gives you the freedom to choose how to spend your time without working just to pay bills. Most people spend their entire lives dependent on their salaries, unaware that there is a way out of this cycle. Financial independence doesn't happen overnight, but it can be achieved by following a strategic plan. The first step is reducing your expenses. Many people spend everything they earn without leaving room for investments. By cutting unnecessary costs and living below your means, you create a margin that allows you to build financial freedom. The second step is building an emergency fund. Before investing, it's essential to have a safety net to cover unexpected situations. This prevents you from relying on loans or credit cards whenever an emergency arises. A good starting point is saving 3 to 6 months' worth of expenses. The third step is investing in income-generating assets. Financial independence comes from building wealth that works for you. Investing in stocks, real estate funds, dividend-paying assets, and personal businesses are some of the ways to create passive income. The earlier you start, the faster compound interest will grow your money. Shifting your mindset is crucial. Financial independence is not just about earning more money, it's about learning how to use it wisely. The more you understand about personal finance and investing, the closer you get to living without depending on a paycheck. The key is consistency and patience, as time is the greatest ally of those striving for financial freedom. The rich don't work for money, they make money work for them. And the biggest secret they use to build wealth is the power of compound interest. Compound interest works like a financial snowball. At first, growth seems small, but over time, earnings begin to multiply on their own. This happens because the interest earned on an investment is reinvested, and in the next cycle, you earn interest on top of your accumulated interest. Imagine you invest $100 per month in a fund that returns 10% per year. The secret is to start as early as possible and let time work in your favor. The longer your money stays invested, the more it grows automatically. That's why the rich understand that time in the market is more important than trying to time the market. Those who use compound interest correctly turn small amounts into massive fortunes over time. The biggest mistake most people make is either waiting too long to start or withdrawing their money before the real growth happens. The game of the rich is simple. Invest early, invest consistently, and let time multiply your money. FIRE, or financial independence, retire early, is a movement designed for those who want to achieve financial freedom and stop working long before the traditional retirement age. The core idea of FIRE is to accumulate enough wealth to live solely off investment returns, without relying on a paycheck. The path to FIRE is built on 3 fundamental principles. The first is living below your means. FIRE followers avoid unnecessary expenses and direct most of their income into investments. This accelerates wealth accumulation and lowers the amount needed to retire, since a lower cost of living requires a smaller investment portfolio to sustain it. The second principle is investing aggressively. Instead of letting money sit in a savings account, those following FIRE put their money into income-generating assets, such as stocks, real estate funds, and ETFs. The goal is to build an investment portfolio capable of supporting their lifestyle without needing a job. The third principle is the 4% rule, which estimates that a person can safely withdraw 4% of their portfolio per year without depleting it. This means that to live on $40,000 per year, you would need $1 million in investments. FIRE doesn't mean quitting work and doing nothing. Many who achieve financial independence continue to pursue passion projects or businesses, but with the freedom to choose how and when they work. The FIRE movement provides an alternative to the traditional career path, offering a way for those who want to escape the rat race and live without the pressure of a fixed job. Many people believe they need a lot of money to start investing, but the truth is, you can begin with as little as $10. Today, several investment platforms allow small deposits, and the secret lies in using the right strategy and staying consistent. The first step is to choose a broker with low fees that allows small investments. Platforms like Robinhood and M1 Finance in the US enable you to start without requiring large initial deposits. Next, you need to decide where to invest your money. One of the best options for beginners is ETFs, such as the S&P 500. With just $10, you can buy a fraction of one of the most stable and profitable assets in the long run. Another option is fractional shares, which allow you to invest in big companies without needing to buy a whole share. The key to success isn't the initial amount, but consistency. Investing $10 every week may seem small, but with compound interest, that amount can grow exponentially over the years. What truly makes a difference is not how much you start with, but how long you stay invested and how disciplined you are in making regular contributions. The biggest mistake people make is waiting until they have a lot of money before starting. The most important step is to take action and develop the habit. The sooner you begin, the more time your money will have to grow. Even with just $10, you can start your journey toward financial independence today. ETF stands for Exchange Traded Fund. It works like a bundle of investments that contains multiple stocks or other assets. Instead of buying individual stocks, you invest in an ETF and automatically gain exposure to several companies at the same time. The biggest advantage of ETFs for beginners is automatic diversification. When you buy an ETF like the S&P 500, for example, you're investing in the 500 largest companies in the US, including Apple, Microsoft, and Tesla, without needing to buy each stock separately. This lowers risk because if one company within the fund drops in value, others can balance out the loss. Another reason ETFs are great for beginners is their low cost and simplicity. Instead of spending time analyzing individual stocks and trying to predict which will rise, you can simply choose a high-quality ETF and let your money grow over time. Many ETFs have very low management fees, making them more cost-effective than actively managed funds. Additionally, ETFs are highly liquid, meaning they can be bought and sold as early on the stock exchange, just like any stock. This gives investors the flexibility to enter and exit the market without major complications. If you're just starting in the world of investing, an ETF can be the safest, easiest, and most effective way to build wealth. With just a few clicks, you can begin investing smartly, taking advantage of diversification and compound interest for long-term growth. The biggest concern for new investors is losing money. While every investment carries some risk, there are 3 golden rules that can protect your wealth and help you make smarter decisions. The first rule is never invest in something you don't understand. Many people lose money because they jump into investments just because someone told them it was profitable. Before investing, it's essential to study and understand how the asset works, what the risks are, and the best strategy for it. If you can't explain in a few words what you're investing in, you probably shouldn't put your money there. The second rule is diversification. Never put all your money into a single investment, as this significantly increases the risk of losses. Investing in ETFs, real estate funds, and different asset types helps balance your portfolio. If one investment doesn't perform well, others can compensate for the losses. Diversification protects your wealth and reduces market volatility. The third rule is thinking long-term. Most people lose money because they constantly enter and exit the market, trying to guess the best times to buy and sell. This impulsive behavior leads to poor decisions. The secret of successful investors is to buy solid assets and hold them for years, allowing compound interest to do the work of multiplying their money. If you follow these 3 rules, invest only in what you understand, diversify, and focus on the long term, your chances of losing money drop significantly. Investing isn't about luck. It's about strategy, patience, and discipline. Many people believe they can only invest when they have extra money, but the truth is that those who earn less need to invest even more. The key to building wealth is T, about having a high salary, ISA, about how you manage what you earn. The first step is adjusting your expenses. Before investing, it's crucial to find ways to save money. This doesn't mean cutting everything and living miserably, but rather eliminating unnecessary spending. Small changes, like canceling unused subscriptions or avoiding impulse purchases, can free up money to start investing. The second step is setting a fixed amount to invest each month, no matter how small. Even if you can only invest $10 or $20 per month, it's a start. The most important thing is building the habit. Over time, as you get raises or find new income sources, you can increase your contributions. The third step is choosing the right investments. For those earning less, the best approach is to invest in affordable and diversified assets, such as S&P 500 Many brokers allow small investments without requiring full stock purchases. Another good option is real estate investment trusts, which offer returns without needing large upfront investments. Finally, patience and discipline are essential. Investing on a low salary doesn't mean getting rich overnight. It means building wealth that grows over time. The key is consistency, because even small amounts invested regularly can grow into a significant sum in the future, thanks to compound interest. The most important step is starting now, regardless of the amount. Time is the greatest ally for those who want to build wealth, and the sooner you begin, the faster you'll reach financial independence. Many people avoid investing because they believe it's too risky, but the truth no one tells you is that not investing is even more dangerous. If you leave your money sitting in a bank account or a savings account, it loses value over time due to inflation. This means that year after year, your purchasing power decreases, and you're actually getting poorer without even realizing it. What really makes investing seem risky is not knowing what you're doing. People who enter the market blindly following random tips or trying to get rich quickly often make poor decisions. But those who understand the game know that the biggest risk is not investing at all. The key to reducing risk is investing for the long term and diversifying. Buying assets like S&P 500 and strong companies allows your money to grow safely over the years. The longer you hold a quality investment, the lower the chance of losing money. The real question you should be asking isn't, is investing risky? But rather, can I afford not to invest? Working your entire life and depending solely on a paycheck or government retirement benefits is far riskier than putting your money to work for you. Investing isn't about luck, it's about strategy and patience. If you learn the right principles and invest wisely, risks become manageable, and your growth potential becomes limitless.